You're listening to Fund Shack. I'm Ross Butler, and today I'm speaking with Edward Talmor-Gera, founder and CEO at NewVest, a company that's been described as the vanguard of private markets. In other words, it provides low-cost, diversified index funds for private equity, private debt, and other private market strategies. And I'm also here with Matthew Chapman, who's a director at NewVest. Matthew served in the British Army. He worked at JP Morgan, Partners Group, and a fintech involved in the democratization of private markets. And they're both here with me now. Gentlemen, welcome. You are doing something that's really quite innovative, cutting edge, and surprising, which is you're introducing passive exposure to private markets. And this is surprising because the folklore of the industry, at least as far as I understand it, is that this is something that you can't do because it's just practically just too difficult. And it's also something that you shouldn't do because buying the average is something that doesn't make sense in private markets because of the long tail, and the poorly performing funds dragging everything else down. That's the kind of the pseudo-intellectual folklore. Why is it wrong?
I would say that David Swensen, who's an important figure in the industry and wrote the book Pioneering Portfolio Management now 25 years ago, wrote in the book part of what you just said, which is that indexing in private markets is impossible. But he did also say something in contradiction to what you just said, which was that it would be ideal. And I think that I would challenge. I'm not sure that people think that the average is not good. I think private equity appreciates today that median returns have been great. A lot of the studies around PME, the alpha that private markets have over public markets, when using the median level of return, has been very attractive. So private equity has been great. We are highlighting the last couple of years now, very much the fact that the average, the cash flow weighted average, sometimes referred to as the pooled return, as disclosed by the many data providers out there today, has had a consistent alpha over that median. And if we look at the last 20 years, it's more than 300 basis points average alpha over the median. And that's because what I think people do appreciate very much, that in private equity fund level returns, very similar to pretty much most other asset classes, you have a right skewed distribution profile to the level of returns. So if it was a normal distribution, average and median are the same. The moment you have a right skewed distribution and you have some phenomenal outlier winners, it makes it really exciting. And the whole active part of the strategy, picking which fund is going to be the best fund this vintage year, is highly valuable if you get it right. And there are some amazing, phenomenal alpha generating strategies out there that really perform phenomenally well. They really help bring the average up. The thing is that statistically, what we found, approximately 70% of funds in any vintage year in private equity end up being below the average and 30% being above the average. And so being able to just get that average to basically sleep well at night and consistently year in, year out, deliver that average level of return for private equity, the pooled level of return, which has got a great premium over the median, is, I believe, very attractive, certainly on a risk-adjusted basis. And I can get into a bit more detail on some of the call it quasi-academic research that we've done, which can make the case even more strongly.
Well, that you said year in, year out, and that's part of it, isn't it? Because you might be able to beat the average once or twice, but on a consistent basis, presumably it becomes increasingly difficult to do.
I think that's exactly the point that we delicately have tried to showcase. At least we've looked at those investors, those LPs, allocators that make their private equity returns publicly available over a long period of time with 20 years of data. So we looked in particular at the US public pension system. And you have well over 50 of those US public pensions that have that 20 years of historic data. And what we found is that in any one year, roughly 1 in 5, maybe 3 in 10, on their portfolio basis, have outperformed the index, the pooled return. But nobody, there was one that seemed to do so consistently over 10 years. Only one out of the 55 that we analyzed. Everybody else sometimes got it right, sometimes got it wrong, and more often than not ended up getting it wrong. And
who was the one?
I think Masprit. It's all publicly available information, so happy to share that. But sometimes talking about the public pensions, the LPs, important to stress, they're advised by the gatekeepers and the funds of funds. And so it's a little bit easier to bash up the fund of funds. So there are the very large fund of funds out there that also are publicly listed today and have their information publicly available. And this is where we sort of are proudly poking the bear, if you like. And we looked at, I don't know if we should mention by name, but the very largest fund of fund that is listed today, and there are a few, but the very largest one, they've had a 23-year track record of their primary flagship fund of fund program, where they're supposedly getting the best access and ability to diligence and choose the best managers, and gross of their fees, just their ability to pick has proven to be subpar, has never once actually managed in that relevant vintage year to beat the pool return of the same vintage year. And when it comes to doing diligence and so on, people sort of challenge us sometimes on this, and I love to point out that it's that particular one and two of the very largest fund of funds that claim to have an amazing amount of ability to do great diligence are the two that back the one fraudulent case of private equity in the last decade, a barrage.
So this is a kind of a tough message for the industry, really, isn't it?
I think it's a very good message for the industry. I think it's about saying, just like in public markets, finally, now you have the tool to allow for more optimal portfolio construction by using both a passive anchoring of your portfolio in a sort of core satellite approach alongside your active management, your selection, and attempt at doubling down where you believe you have the high conviction, more concentrated risk ability to generate real alpha. And it complements the utilization of a passive tool such as the one we've created, which beforehand just didn't exist. And so you didn't have that option. So I think it's a great message for the industry and say, you can push the economic frontier up, you can improve your efficiencies, reduce volatility, overall cost in your portfolio, whilst at the end of the day, improving returns.
Yeah, it shouldn't be a surprise to the market because of the public markets. It's such a dominant theme, passive investing in public markets. If you look at the US equity market, over 30% of that market is managed under index strategies today, academic research shows. So really what we're taking here is a mega trend that's grown from the founding of, the first index mutual fund by Vanguard about 50 years ago today, and has transformed the markets to the point where it's the dominant style of investing. And we're applying that to another part of the equity market, the private equity market. And so whilst it shouldn't really be a shock to people, it is for some reason. And I think that's the really curious and interesting business that we have here.
Well, this is why I described it as folklore.
Yeah.
Is that what we think?
I think there are intrinsically some very big challenges in investing into private equity. It's very attractive as an asset class. And I've been teaching about the asset class for well over a decade, almost 15 years now. And I can tell you that people are appreciative that this is an attractive asset class they would love to get exposure to. And if one mega trend is in the public security side, the adoption of ever more passive instruments, the other mega trend we see in finance today is a growing appetite for private market fund exposure amongst both institutional and private investors. And so there is demand for private equity, private debt, etc. But there are challenges. It's not trivial how to get that exposure. So up until now, you've had questions around concentrated risk as versus diversification. You've had constraints around ticket sizes, so the minimums required to invest into an index, such. There is the question of just being able to find and source and screen and diligence and choose which fund you're going to do. It's a heavy resource, and there's a lot of science, and there's also a lot of art to being able to pick which is the best fund. One of the things that we talk about often in class, and there's a lot of academic research about this, is that amongst private equity funds, they may have a good, consistent track record and history of performance, but on a relative performance basis, who's the so-called top quartile? There is a lack of relative performance persistence, meaning, put simply, if your last fund was top quartile, statistically, you're pretty much just as likely to have your subsequent fund be top, second, third, or fourth quartile. And if your last fund was bottom quartile, you're also just as likely statistically to have your subsequent fund be a top, second, third, or fourth quartile. So using the past track record in a scientific way to try and analyze that and based on that determine the future potential of making a further investment with the same manager is really difficult. And so that's where I think these challenges can be addressed and have a somewhat of a solution that will make things a little bit easier for investors to get exposure to private equity without the same risks, with less volatility, with a much easier approach to how they can build that exposure. If they are very constrained on their resources, capital, human and other, they can use an index as a one-stop shop and just buy the index. And if they have a deep bench of resources, then they can go about it with a core satellite approach. Just like in public markets, we've seen this is a way to improve your optimal portfolio construction. And the core could be either our private equity type index, which is just the broad diversified exposure across the entire asset class. So you get more than 70% of the asset class each year. And then your satellite might be a manager that's giving you a lot of co-investment and you're reducing your gross to net fee spread, or it's a niche manager in a small part of the market, etc. And it could be the flip. It could be that your core holding, as you continue investing with some of the big managers, and put down substantial ticket sizes that get you discounts on fees and those co-investments, and then your satellite is niche areas of the market that you might not have the resources to go and explore, such as the new emerging energy transition space within private markets. And you go to an index such as ours in energy transition, because that's your de-risk way of buying the beta of that theme without having to pay a bet where there's going to be blue hydrogen, green hydrogen, I jokingly say pink hydrogen, or distributed nuclear, or just highly levered PV. And so that's another approach to it.
Performance persistence of specific fund managers over funds, is that a myth?
The relative to one another. So who is top quartile? To remain quartile, you could remain top quartile, but there's few and far between who do so. And so in being top quartile in the past, the myth is that if you were top quartile in the past, that gives you assurance that you should continue investing with the same managers just because then they will be top quartile again. That's the myth.
Right.
When I speak to a pension fund or an insurance company, for example, they'll often have a relationship set up with a single manager or an investment consultant with a kind of limited pool of relationships that they recommend. And based on that, they're already set up to, receive that problem, which is that they don't know, will their next fund perform as the last one did. And because there's not been an index approach to invest in private markets, there's been no effective way of challenging that assumption that you have to try and pick the top quartile funds every vintage instead of just buying the market. And I think the market's set up in a strange way as well, because if your business model is on, we are the best selectors there are, then an index is the opposite of what you're going to want and what you're going to want to talk to clients about. And so when I speak to pension funds and insurance companies and endowments and foundations and individual investors as well, they're already kind of being advised that they should try and pick the best. And actually for them saying, well, why don't you get your advisor to think about an index, is they see the benefit straight away because of what we talk about. But it's very difficult for them to get to the stage where they can actually diligence and look at and compare. And so the easiest way of doing it is just to go onto one of the data providers, to go onto Burgess or Preqin or Cambridge Associates and compare the pooled return versus your own portfolio returns.
That's part of how we started.
Yeah, exactly.
And do people do that?
Yeah. Well, not enough. It's probably what we'd love to do is if everyone listening to this today would, got their portfolio and then they compared it to the pooled return and said, how consistently have I beaten? How consistently has my selection beaten that pooled return?
So what's the best way to benchmark your private markets portfolio? Is it to go onto one of those data providers?
Well, I think it's a great...
I think so. And to do so properly on a vintage by vintage basis and look at, a good hard look in the mirror and say very honestly, how successful were you in picking the right managers in that particular year? Did you pick, those who ended up beating the pool return for that year or not?
Yeah. And from what you were saying earlier, Edward, clearly there is a lot of skill involved in private markets fund investment. But to extrapolate what you were saying, you can't cover the entire waterfront in a way that, where you have an advantage. And so you can only have an advantage in certain areas. And that means that you want to be able to, if you want to optimize your exposure to private markets, you need this kind of index passive, maybe that's your core element, and then you dive into the specific areas that you really know well as an institution or a house, where you can then add the alpha. Is that?
I believe in that very much, yes.
Right.
So this is very much viewed as a tool for efficiency at the end of the day. And if you have an ability in a particular niche part of the market to be with a differentiated view and get it right consistently, then absolutely you could take an approach where you want to completely put all your eggs in that one basket. And if you get it right, then you're generating better returns. Or you could take the view that you want to have diversification, and the one free lunch and investment is diversification. So in those other areas which are not your area of ultimate expertise, don't waste your time and don't try the fallacy of picking where you don't have the expertise and buy the index, and make sure you do put the resources to some extent in that area where you have that alpha generating potential, and then your overall portfolio has a more optimal construct to it.
Okay, before we get into the how you do this, does it make sense for everyone? Are there some investors out there, like endowments classically? They're great. They're kind of unconstrained. They can do what they want. They can invest for 1,000 years or whatever. Are there types of investors for whom kind of this doesn't actually make sense because of that?
In my subjective way, I would say the one type of investor who, what we do would not fit for them is the investor that has a agency problem, where there is a certain party involved that's making a decision that is earning their keep based on the alpha part of the strategy. Their personal incentives might be in contradiction to the incentives of the actual assets being invested in creating a most optimal portfolio construction, risk-adjusted return. And that's the only case where I believe they would say, okay, this is definitely not for us. When there's that misaligned interest, if you like, they may be paid as a consultant, they may be paid as an employee or what have you, and they are personally vested to either maybe get a bonus when they get some level of alpha, when they don't want to sort of put a benchmark in their portfolio that showcases the fact that they did or did not do well in their own remit of trying to create that alpha. Other than that, I think everybody else in one use case or another has definitely got room to improve the way they do things when it comes to investing into private markets by, to some extent, utilizing passive index kind of product exposure within their portfolio. Not necessarily, and quite often, not as their entirety. That would only be the case when you are with no resource, no human resource, and very limited capital resource. Then it's a one-stop shop, and that's the only case when you just use the passive index approach. But when you have any level of capacity to do more than just a one sort of limited ticket a year, then absolutely augment passive with active and create an optimal portfolio in that way.
So you mentioned David Svensson at the start. If he were still around, so at Yale, presumably he would be a fan of this and would even use it.
COVID was a very difficult period for many, and sadly during COVID, both David Svensson and Jack Bogle both passed away, and two people who I would have loved the opportunity to share what we've created here at NewVest. Both in indirect ways were giants upon whose shoulders I felt that we're standing, and so missed that out. On the other hand, COVID was very much what enabled us to start this business. So appreciate the opportunity came up through that crisis too.
And so, Matthew, when did you join NewVest?
Yeah, I joined NewVest earlier this year. I was previously at Partners Group, but I met Edward some years ago when he was, I think, the first super return that you spoke at. And he gave this fantastic presentation that I still remember. There's this one slide that kind of said, all roads lead to indexing. Like, if you're worried about this, why don't you index? What about this? Why don't you index? You probably tell the story better than I do, but it stuck with me through that time. And at the time, I wasn't the right kind of fit, and the business was really early, and we stayed in touch. And then it came to the point now where I've been able to join, and it's just I'm just really excited and passionate about being able to change markets to make them better for the end investor, for the beneficiary, for the pensioner, I think that we're doing something that, is going to change the world.
Yeah.
Essentially.
So you are kind of intellectually, you bought into it through the presentation. If you can allow people to buy the median pooled return of private markets, that's going to be a good thing for the world. I want to be part of that.
Yeah,
Right?
exactly. And I don't tell the whole story, but we were lucky enough to sit on the plane on the way home together just by pure fate, and that did it for me.
And the rest is history.
Yeah, the rest is history.
Well, that's a nice segue onto the how then, because okay, we have this. We think it makes sense now. But actually, it's still a very difficult thing to do. So how have you gone about it? What are the mechanics of giving people this access?
The first level of structuring of this is nothing new. It's the tried and tested legal framework of what we call a fund of fund, a closed-end, non-listed GPLP structure. And the idea is that we're going to try and evolve or even disrupt the way the funds of funds work. On two levels. First, I viewed the world of fund of funds and saw that they were getting a really hard time. It was a sort of a diminishing asset class business model, mostly because of the double air fees, which a lot of investors, for various reasons, regulators and politicians and investment committees were all very much shying away from having that exposure through double air fees. So the first thing we did on a business model perspective was to come out with an idea of not charging any management fee, only a profit share and a very low one at that. So in the same way that passive instruments and index funds in public markets were very much about a real challenger and being very low cost, we wanted the same idea to be put to play within private markets. So when we look at a gross to net spread on an IRR basis, we are very, very disruptive, challenging. We believe we are less than a tenth of anybody else out there in that fund of fund world. So that was the first thing.
Could you just say what your structure is then?
So it's a no fee, carry only, and for 10 million plus LPs, it's a 6% carry, and we discount that carry level for larger LPs.
Zero management fee.
Zero management fee at our level. We obviously pay the underlying funds,
of course, yeah.
But at our level, as a fund of fund level, secondary fund, feeder fund, etc., those are the ones to compare to. We do not charge any management fee at all. And the thing that we came out with as a first, which is passive investing in private markets. And that's the other part of how this works. And it's the investment philosophy. And basically the idea is that the fund of fund that I described program is an annual program. So every year we would look to invest and commit and subscribe to 50 of the largest private equity funds. And I use the target fund size of those underlying funds to determine who are the largest. We have to get the access to them, which is certainly not trivial. And once they allow us to have the access, we weight the exposure to each one based on their target fund size. Now, what that ends up delivering is an expected exposure to more than 75% of the asset class in private equity each year with a capital weighted exposure. That, by definition, statistically will emulate the said pooled return, the average of the asset class in that year. So that's sort of the basics of how it works. We actually become a real LP in 50 those funds in private equity, 50 funds in private debt each year. And that's kind of very different to what else is out there that are synthetic, passive replication strategies that have been talked about so far in the market. This is the first one really, truly going in and investing year after year into more than 70% of the asset class.
Okay, so people that know about private markets fund investment, if they know anything, they'll know that actually part of the difficulty is actually getting access to these, particularly if you're going after the world's top 50. These are the most difficult funds to get into. So how are you getting access to them? And to what degree are you actually getting into the top 50?
So something we're very proud of, we had tremendous support from the industry, from the GPs themselves, who heard our story, understood what we're trying to do, and have given us access. So in our inaugural product, the 2023 vintage of private equity, there was one GP that didn't give us the access that we wanted. And that was okay. We went to number 51 down the list. And that was part of the model. When we set out, we thought we'd get at least 80% access. We didn't expect to get 100% or just one single one saying no. We expected 80%, and we did the back testing to prove that would have been enough. That same one who said no last year when 24 came along this year have said, well, actually, you talked to the wrong team, what have you, this, and they've been said, please let us be part of the index. And as we're passive, we won't hold it against you. Didn't let us in last year. We're happy to invest with you this year.
So you got 98% coverage last year, 100% hopefully this year.
Depends how you count.
Depends how you count it, of course.
But one single one who said no last year that should have been in there from the GPs. And this year, every one of the GPs that we approached, that we thought and believed should be in the index. It's about going and trying to assess the market, who's fundraising and covering it all. So maybe there's somebody we didn't manage to talk to and we didn't find or we didn't know of, but we've tried to cover the market as best we can. And I believe we've very well covered it by now. Every one of the GPs we talked to this year said, absolutely, you can have access. And
so you've got Blackstone funds, Carlyle, Thoma Bravo, all the big ones.
Yes, and KKR and Insight and Clearlake and Bain, and all of them have been amazing supporters. And last year, some of those that even in a difficult fundraising environment were still oversubscribed, TA and others all gave us access.
So why? Why did they? I mean, presumably, first of all, they will have minimum ticket sizes. You're a relatively new company doing something very innovative. Why don't they just wait until you get bigger? And why have they agreed to this?
So what they had to agree to was to first accept us and let us become an investor, a limited partner of theirs. And secondly, they had to agree commercially, and this was the ask to make it not completely trivial, to let us in with a ticket size which was below their minimum, below their stated minimum in every single one of the cases. Obviously, we subscribed to close to 100 funds in the first year we launched. If you think that the average minimum ticket is north of 10 million, would have needed well over $1 billion just before I started even to have $1 billion, which we did not have. And so we did ask them to let us in below their minimums, and they agreed. And why? I'd say there are two aspects to why. The first is I think that they all very quickly bought into the vision and appreciated that there should, as we were saying earlier in the conversation, be a room for a passive allocation strategy, an index approach to investing into funds in private markets, just as it exists in public markets. So they bought very quickly into their vision and appreciate how also in public markets it grew the pie for everyone. So this may grow the pie for them. It's something that's appropriate for a lot of individuals. It will help the story of the democratization of private markets and many other aspects. So they bought into that vision first and foremost.
So can I just ask about that? Because it would be fascinating to have been a fly on the wall in those discussions. What was the reception like? Was it like, wow, we can't believe you're doing this, or we can't believe no one's done this, we've been waiting for someone to do this? What was the general reception like?
There's a bit of both of those. And my favorite one is, heck, can I please invest my own personal money in this?
Right.
Which we got quite a few times. And actually a real portion of our investors last year in the first year were the partners from the actual GPs, where they put a lot of their money, as they should, into their own GP commit, which is strong alignment of interest that the industry has. But with not all their money goes just into their own GP commit. And what else did they do with the money? Typically, very compliance constrained. They buy real estate and spider ETF index funds in public markets, and they believe intrinsically in private markets. So they saw what we were doing. They said, please, can I invest in you? They said, and I said, absolutely. And so we have quite a few investors, several dozen individuals from the sort of top leading GPs who have invested in us.
Who really know the market. That's amazing, really, because when you think, okay, yes, as you said, a lot of their private capital will already be in this asset class. And so you might think, well, they're going to want diversification into whatever else, forestry and gold. But no, they've chosen diversification into the rest of the asset class.
As we said, alpha picking, they believe in their own strategy, they believe in themselves, so they have a overexposure to where they believe in most, and intrinsically have an advantageous position as their GP commit. It's with lower fees and lower carry, and so that approach is absolutely corroborative of what we were saying before, in that that's their alpha part of the private market exposure, and through us, they're now getting the passive side.
That's a huge amount of kind of, on the one hand, explicit, but also implicit backing as well for what you're doing from the people at the center of the industry, really.
But I'll give you, going back 3 steps to the story of why they gave us access, and at least always love sharing the pitch that we gave to them, which, as I said, was the time of COVID, so it was all over Zoom. I would say if it wasn't for that, we'd have had to go and wine and dine all of these GPs all over the world. Would have gone bust way before it got started. So it was very much thanks to being able to do so over Zoom that allowed us to be very cost effective in this. And it was a short conversation where basically I said, please let me be your best LP ever. And they sort of, what's that? I said, I promise I'll be your easiest. And typically this is to a head of IR or an IR individual, and they start to smile. And I say, I'm not going to send you a 100-page DDQ. I'm not going to ask you to bring your founder, senior partner, tell me about that deal 10 years ago that lost money and tell me what's your lesson learned. I'm not going to, like the gatekeeper funds of funds, say only if you give me free co-investment and you block my competitor from getting that exposure or preferential treatment to some access to secondary deals in your funds, will I then say that you are a worthy primary fund that's going to get allocation? I'm literally your easiest LP. And over time, I believe I'll become one of your biggest LPs. I may start small, but also I'm not going to start too small. I won't come and ask you for a $62,000 ticket. I'm going to launch this with a position where I'm going to invest in the first year in 100 funds, and the smallest ticket I'll write will still be north of $1 million. It's going to be capital weighted. So if you're the bigger fund, you'll get more than that. If you're the smallest fund in the index and still you are a multi-billion-dollar fund, you'll get, starting at $1 million plus. And based on that, everybody but one said yes.
Okay, so this begs the question: what's in it for you, right? Apart from, particularly now when carry is presumably several years away.
A carry model on a pooled return is highly attractive. If you think of many of the underlying funds when they are, trying to generate that carry, that profit share to themselves, but there is, as we said, some funds do better than others. There is a lot of volatility in their level of returns. Then how much actual dollars in their pocket will result from that is unclear to them. When we look at the pooled return level, with its much lower volatility, we estimate the standard deviation of pooled returns over the last 20 years was less than 3% in private equity. And in a single year investing in private equity funds, it's more than 22% standard deviation on the returns. So with that lower level of volatility, we have a very high confidence in the fact that we'll be generating revenue, which is a profit share on the level of pooled returns. The worst vintage still returned 1.55 net return multiple in private equity. So we would have still generated a nice, profit share on that 55% of profit on top of the actual money invested.
So it makes you as a team super aligned actually as well.
Very much aligned. It's a very LP-centric business model. More, I'd say, LP-centric than I'll be happy to take the challenge of any other advisor out there, where we're really only earning money from our investors' capital that we are deploying for them once they've received back all of their investment and only as a share of profit. And I think that's a very aligned business model.
Sorry, and Matthew, were you going to add something to
that? Well, I can hear the voice of compliance ringing in my ear saying we also offer a management fee only basis. So alternative.
Because I've had some people say to me, really, indexes is all, not picking anybody, and so why should you get, a share of the upside in that way? And it's just a fixed thing. I say, well, if you really insist, pay me a fixed management fee, low management fee. And it ended up being, so far at least, always a academic, intellectual debate. Even those who sort of, challenged and asked for it, when it all was said and done, ended up choosing the carry model.
Okay, so you've got the access. It's a fund-to-fund structure. And so this is the other interesting thing. Everyone's talking about democratization and retailization, but for me, this is the really kind of epoch-altering innovation in the market. And it's actually happening through a traditional fund-to-fund structure targeting traditional institutions.
Yeah, I mean, the tools exist to create products that fit every portfolio today. And I think our product is well suited to anyone that needs exposure to private markets. It serves individual investors, obviously appropriately qualified to invest in the asset class, but it helps them because they immediately get a fully diversified portfolio to the asset class. So for them, it's they don't have the capital to write 10 tickets themselves each year or however many they need. Then going up the scale, the larger institutions see the performance benefits of investing in the index, the median return versus the mean return, and see that that it's advantageous to diversify using that as well and get those returns. So yeah, it's old-fashioned technology, but it's
collaborative with all of the cutting edge new technology, new business models, and new frameworks which are going after the democratization and the retailization of private markets. And we look to, in a very collaborative way with them, enable them to allow for a better form of retailization of private markets. Instead of them having a adversely selected exposure to some funds that they're making available with their additional layer of legal and technology and product and commercial offering, do so on an index which has got that inherent lower risk, lower volatility with no adverse selection. And that is a more appropriate thing for an individual who doesn't perhaps know enough about the asset class and is taking risks that they don't necessarily appreciate well enough.
Yes, you could be a feeder fund for people selling to the retail market. Or the other way around.
They would be a feeder fund to us, but they would bridge that last mile.
Yeah, see, this makes a lot of sense because the big risk, of course, with going ever further down the pecking order is the risk of a PR blow up.
Absolutely.
Where are you getting the most amount of traction? Where are people saying, this is what I've been waiting for?
Well, the fantastic thing is that when we pitch this product, when we talk about this product to people, there's a light bulb that goes off immediately. It doesn't matter which investor you're talking to. People understand it within the first 2 minutes. And so our current investor base is very varied. We have institutional investors from pension funds, banks, and insurance companies. We have individual investors investing as well, and we have a distribution relationship with a distribution partner. And so we're really looking at partnerships across the board to continue to grow.
Are there any examples of feeder funds coming into you to allow semi-liquid access yet?
Yes, we have. Julius Baer has created a product using a certificate structure that allows individuals to come in with smaller tickets, starting from $125,000, that can invest in us. And there is a form of semi-liquid there. It's redeemable against Julius Baer after an 18-month lockup.
Okay.
One thing we're kind of quite opinionated on is semi-liquidity as a concept, and one problem with semi-liquidity is that you have to sacrifice the core assets, the private equity holdings, in order to hold some more liquid instruments to provide that investor liquidity. And through cycles and through market events, that liquidity can be used up very quickly. And these semi-liquid funds are semi for a reason, because they can gate and close, and then you don't have liquidity. And it's often in the time of most need that you don't have the liquidity.
And the rest of the time you're holding it, and you're sacrificing the illiquidity premium. And so you're giving up a level of returns. The returns in those semi-liquid products are not going to be reflective of those very attractive, full pooled level average private equity returns. And so we think that it's a great step forward for another part of the market, but it doesn't quite deliver truly private equity pooled level returns, which will be much higher, we believe. And I think that one can address the need for liquidity of investors, especially private individual investors, as they come into the asset class in a better way. And we're in the process of having that, something which is under development. Will probably before the end of the year, you'll be hearing more from us on this as a further step forward, further innovation in private markets, how to make this more liquid, if you like semi-liquid as well, because it's not fully liquid in the definition of being a public listed security, but it's going to be a better form of providing potential liquidity for investors in the index, than those who are investing in some of those semi-liquid open-ended structures today.
Okay, well, we will wait to hear more. I mean, I guess my position on this has always been that I kind of think the industry has kind of got like a bee in its bonnet about its illiquidity. Anyone can go out and buy a 5 or 10 year fixed rate bond and no one blinks an eyelid. And I think most people have probably got one in their pension. There's no big deal about it, particularly if it's in your pension. And so why does everyone worry about illiquidity in private markets? It's only because of the stock markets and the kind of the quarterly returns and the constant trading there. But that, for me, is the weird and actually quite a value destructive thing. So.
I couldn't agree with you more. And I've often said in class, being very facetious about things, that in many a time, private equity fund investing is more liquid than public equities. And I always refer to, think back December 2018 or or May 2020, and many other times where public market liquidity dried up. There was no vol trade. And at the same time, I said, there is so much dry powder available by secondary funds that if you're sitting on a interest in a private equity fund at that same point in time exactly, in December 2018, when everybody else was off on holiday, if you'd have asked me to find you a buyer, 5-10% discount, not like the 30% which was in public markets drop overnight, I would have found you 4 potential buyers in 24 hours that would be happy to buy most of your fund positions out there. If you're invested in a really sub-performing fund, equivalent to some terrible stock, it could drop 90% overnight. But if it's the run-of-the-mill, well-performing, well-respected funds, there is absolutely an ability to get out for a secondary market sale. And what I alluded to before that we're developing is just an improvement to the process of how secondary transactions in private markets could operate through us, through the index.
It's perhaps controversial, but I think that when you blur the lines between illiquid and liquid, as you have with investment trusts in the UK, for example, you've got particular managers who are putting both types in the same fund, and that really confuses people, and the regulators have to come down hard on that blurred area. And I think that's where...
Like Woodford in the UK.
Oh, yeah.
I know you didn't want to say it, but I can say it.
Thank you for saying it. But I think that's...
And there are others now that have come out with a lot of things in recent months as well. And I think it's a very important point. It's about not mis-selling. It's about being very transparent. It's about truly delivering something. It is what it is, and just being very straightforward about it and positioning it right. And that's doing right by investors at the end of the day.
That's the other thing that the industry have been bad at, just going back to your point on risk, is that, everyone wants to talk about the return of private equity. And so, the FT is constantly trying to pick holes in that. But the truth is that the really attractive thing about the industry is kind of, as you say, it's not as risky as people seem for the return. The risk-adjusted returns are great because, particularly if you're invested in a diversified manner. So
we did some analysis on this, and we believe that roughly 10% of private equity funds, when it's all said and done, post-ante, have actually lost money. And when I say lost money, it doesn't mean that they wiped out the entire investment.
Yeah.
They've returned 98 cents on the dollar, 90 cents, 80, 70 cents on the dollar, some amount. So you have only 1 in 10 private equity funds historically have not made a profit. So returned all your money back and then some. That is a phenomenally low number, in my opinion. And so that is reflective of the fact that as an asset class, actually private equity is not in that way a risky asset class like other asset classes might be. Yeah. And then when you think about the expected return, which historically has been presented as the median return, and we would going forward suggest the expected return, your benchmark should be the pooled return, like the index is going to emulate. Yeah. Then on a risk-adjusted basis, it is absolutely one of the more attractive asset classes that's out there to invest in.
Yeah. Given the psychology of this, and there's this, there are these industry experts, the fund of funds and so on, who are likely to be fairly resistant to this model. Could you get the kind of perverse situation where it's actually the less sophisticated investors in terms of knowing all about private markets and private equity that adopt this first and actually start benefiting from it before the so-called experts? Is that...
I think it's there are a lot of the academic theory about adoption of innovation with different waves. So I'd say that if we look back at who invested with us in the very first year, it is the most sophisticated, the most intelligent, intellectual investors that actually got it and were true enough to themselves to admit, how does this make their investing world better? And were adopting it truly as we said, as a core-side approach. They kept on doing active management, and they had room for this, and they got it. And so I'd say the most sophisticated, the most intelligent of investors that I spoke to were the ones that actually were the first and early adopters of it. As by not by dollar amount, but by count, most of them were the senior partners at different GPs who have tended to be very intelligent people that I met in the world of finance. But it's also a leading bank and insurance and university endowments that tend to also very often have a very forward-looking and sophisticated approach to investing. So we have a good mix in that way. The next wave is about those that are willing to be early adopters, because at the end of the day, this is a financial product, and we're talking about financial institutions that have very heavy fiduciary obligations and a lot of fear when it comes to their role in investing. So, they would love to be able to say, well, I'm investing, not to use names in our industry, but when I was a kid, I remember the expression, people said, you're not going to be fired for investing in a stock of IBM. I don't know if that's hold true today anymore. IBM still exists, but I don't know if that's the same thing today. But, excuse me, I think that you probably won't be fired for making an investment with any one of the largest funds. So it's a safe play for your job. But choose to invest in one of those not because you're fearing for your job. It's because you believe you're generating the most risk-adjusted return potential in picking that large manager, in picking that secured position, and be open to the fact that on a optimal portfolio approach, you could invest in an index, even if it only has now a couple of years of track record that we can show. But understand what it is, truly do your diligence, truly do your work, appreciate the value of the improvement of the strategy and how this can be a tool for efficiency and more optimal exposure in your portfolio, alongside the other aspects of your investment, which is going to be where you take your skill set and put it to play in the best possible way to generate alpha with more concentrated risk. And so that's about who I believe will be the next wave of early adopters.
Yeah.
It will take time until it's sort of very broadly adopted. And I just say in public markets, Matt mentioned Vanguard, 50 years ago started. It was 20 years ago when we just started seeing really the beginning of adoption by institutions. Those who started were actually more individual investors for the first 30 years who were more commonly buying into index investing first. But institutions started probably 20, 25 years ago truly investing. And it was still, we have some measure, I think it was 2000 or 2002 when it was roughly 1 or 2% adoption. And then 20 something years later, and more than 50% of inflows were going into passive instruments by institutions. And so, all I could say is I hope it won't take the industry and all of those institutional investors the same 40, 50 years to get to a level of 50% of their deployment going through passive instruments in private markets as it did in public markets. I hope that given that experience and learnings and so much appreciation for the qualities of passive investing in public markets, we'll see a much quicker adoption. And within the next, I believe, 3 to 5 years, 10, 20, 30% of most institutions' allocation will be going through passive instruments in one way or another.
Well, Vanguard's done a lot of the heavy lifting for you, hasn't it?
As I said, we're standing on two massive giants' shoulders.
Right. Yeah.
Both those who have created and educated the market about the value of passive alongside active in a portfolio construction, albeit in the public market side.
Yeah.
And then 40, 50 years of the industry, the asset class of private market funds that have delivered great returns and have proven themselves, creating what is today an ever-growing demand for more exposure to private markets.
This is the surprising thing because, I mean, if you give me access to the largest 50 buyout houses, I'll take it right now. But the surprising thing is that it's not Vanguard or BlackRock offering it to me. It's you guys.
Well, is it surprising? I mean, disruption of industries very, very rarely comes from the incumbent. It usually comes from some disruptor who sometimes gets bought out by an incumbent or becomes a new incumbent in their own right as they create a new part of a market, a new way of doing business, and that's true for so many industries across not just finance.
Yeah. When you're talking about the secondaries, entirely hypothetical, but it would be interesting to see where. Does this make sense? P50 secondaries start trading, maybe relative to the underlyings as well. I haven't thought that one through, but
we believe that it will trade at a discount or premium, but it'll be very tight. So if you think of a single fund within those 50 funds, those historically, if I think of who would have been in the top 50 in a 2015 vintage, obviously the P50 didn't exist back in 2015, but the funds that would have been in the 50 in the P50 of the 50 largest of the 2015 vintage today would be trading typically on a single digit level discount to NAV, and sometimes at a bit of a premium as well. And in times of dislocation, that could go into double digit level discounts. We've seen that also happen over the last 18 months. There's been times of a little bit more stress in the market, and discounts have widened. By the time you take an index approach and you have all 50 in one go, the potential for any kind of information asymmetry, for variance in the intrinsic value in that NAV is substantially reduced. And given sort of, as we were saying before, the approach we're now bringing to the market of the ability to transact on that secondary sense with much less transaction friction that we are planning and everything else, as a result, we believe that the index should trade definitely within a very narrow band around the NAV, small single level digit discount or premium around that NAV. But time will tell. It's still too early. That's still another couple of years out. You need to have enough to be capital be drawn into the index. The first 2023 index is now in private equity about 20% drawn, in private debt 40% drawn. It's another couple of years till there's enough beef in there for it to really start trading with a meaningful indication of what is the discount rate.
So at the moment, you've got the PE 50, the private debt 50, you've got a clean tech index. In theory, though, you could have an index fund for every permutation of private market strategy there is, and they could all be big, and they could all trade on a secondary market that would end up looking something like a stock market.
That is the vision. Absolutely. Yeah. You got it right. The way we think about it, we think of having 4 core products: your S&P 500 Spider ETF equivalent, which is PE 50, private debt 50, infrastructure funds, real estate funds. Those are your sort of 4 core constituent holdings of sub-asset classes. And then you'll have many niche private market asset class, a niche part of the asset class have an index of it. So it could be a geographic focus. Maybe it's Asia exposure. Maybe it's small cap Europe exposure. Maybe it's a country focused index. It could be a sector focus, private equity funds that are investing into tech or into healthcare.
Article 8, maybe ESG. You've got a whole range of topics there.
Ultimately, I say, I know we've made it as a platform with enough indices when I'm able to create an index of first-time funds. Given that we were first-time ourselves, and I'm sure everybody in the industry appreciates the struggles of raising capital as a first-time, what have you. We were last year a first-time fund, first-time team, first-time concept in the market, and closed on $250 million, which I'm really proud of. But at the end of the day, when we're able to create an index of first-time funds, it will have meant that NewVest has established enough of itself and reputation to allow us to raise money to be invested in those first-time funds. And I think it's going to be a very attractive index product to invest in, given the even more right-skewed nature of returns amongst first-time funds.
So how big are you at the moment, and how big are you going to be in a couple of years' time?
Size does matter. We are using the target fund size of the underlying funds to determine how much we're allocating to each. So people ask me, so what's your target fund size? And I say, well, we don't actually have a target fund size, because I can say the following. I think our strategy in private markets is probably the only one who can say that there's going to be absolutely no change, certainly no negative impact to the returns by raising more capital, by definition. Every other one who raises more capital, definitely there's an impact to the returns, because by definition, the strategy would change. Our strategy and exposure doesn't change. It just means that we're buying more of the exact same underlying exposure. So that's the first point, where I don't have a target size, and the more we raise, the better, certainly for us and also for our investors, because there is a very small element of fixed cost, and that gets distributed by across more capital. So
there's an upper limit to that, because if you become a very large part of the market, then...
Yes. You're right, and I look forward to the problem. So just to put it in numbers, last year the 50 largest were targeting $517 billion, just 50 largest private equity. If I was raising an equivalent last year of $50 billion in that 1 year just for the one strategy of private equity, I'd still be less than 10% of each of those funds. And so not yet getting to the level where there is any real constraint, or to your earlier point about moving the markets that much. So there is a lot of room for us to grow to being a annual quantum of, 50, 100, several $100 billion are raised of new capital spread across different products. You're right, though, in theory, like in public markets, people started talking a few years ago, when does it become problematic? When does the model break? When you have 60%, 70%, 80% of the market is passive? You can't have passive without active. Not in public markets, and you won't be able to have that in private markets either. So it's never about, conquering everything. It's certainly not that. It's about being 20, 30, 40, 50% eventually of allocation to private markets going through passive instruments such as ours. And there'll be other competitors and other ways of going about this. I'm sure they will come up. But in terms of answering your question about our growth, so we've gone from 0 to $413 million of AUM in less than 24 months. I believe that that's just the beginning, and you're going to see us bend the growth curve even further. So that I would expect in the next few years it's going to be many, many multi-billion dollars, tens of billions of dollars potential to be raised.
How do my friends in the traditional fund of funds market adapt, evolve, and survive in a world where you're 30% of the market?
Well,
I'm poking the bear, and I've been up on a few panels with chairmen of some of those and so on, and I think their reaction and how they react is my best selling point. Metaphorically and not just metaphorically, they're sweating in their seats, so they have to answer some really tough questions that the investors in the market should be asking. How have you made for yourselves so much money? How have you generated such market cap to your firms when you've charged, hefty fees and carry, generated 30, 40% gross to net spreads, and delivered gross of your fees sub-pooled return over the long term? And that's a real tough question to ask. Generally speaking, when I get up on stage and there's an audience and I present the data, I do say, I am ex-special forces and I've got a bulletproof vest under my shirt. Now I'll show you the data. I'm sure that some of them would love to take a shot at me, a cheap shot or other. And I say, just bring it on. It's really, it's time for them to realize the truth about investing in private markets. They know it. I've certainly heard some of those who've retired from some of those biggest players who say off the record, that they absolutely know that investors should invest with them for their beautifully produced marketing material, certainly not for their investment returns. And so being a challenger, I have to say to everybody, just wake up.
That's fighting talk.
I can add a softer side to that because some people aren't
That's
quite
why
ready
you're
to
here.
be completely disrupted, I suppose. And certainly, it doesn't have to be fund of funds. It can be like a traditional limited partner who has an investment team that are doing their business.
Yes.
And the expertise there. It's like having a giant weight lifted off your shoulders because all of a sudden you don't have to worry about achieving the pooled return. You don't have to worry about the benchmark because you can get the benchmark. It's all about the alpha, the incremental upside that you can achieve. And so, if you're the LP, then you can find, some really great outperforming funds in the smaller fund sizes or in the target market that you're focused on. So it's, maybe not advice for them specifically, but, you can look to specialize and outperform in the niche.
You could say to the funds of funds, if they're able to overcome the view internally of what is their current business model, which is generate their money, and say, okay, where's the industry going?
Yeah.
So they should be themselves taking that core satellite approach to the portfolio that they're constructing on behalf of their investors. And as I said, that core satellite can come in the form of, the large mid-cap part of the market, the 50 largest. They themselves can go and try and buy all of those or use a tool such as ours.
Yeah.
And then, to Matt's point, find niche parts of the market where they can generate a lot of that potential alpha by picking the right sector, right timing, right geography, right particular manager. Or they can flip that and look at saying, well, we're just very efficient, very good at producing the reports for you, and we'll choose, a handful of the larger funds that we believe are the best, and we've got the access to secured already. And in the niche parts of the market, instead of trying to find which is that high conviction smaller manager, whatever, they'll just buy an index of small cap Europe and mix up lots of different indices of market weighting of. Is it, Asia? Is it Europe? Is it US at this point in time? Is it sectors? And take a portfolio construction approach by timing of market sectors, geographies, security types between private equity and debt and real estate and infrastructure, and deliver that portfolio most optimally by just putting the components through indices in each one of those.
Yeah, it's not the end of fund of funds. There's a continued path to relevance for them. And there's no need to be, let's say, embarrassed about what they've done thus far, because that was the market. You know, you don't blame an egg for not being a chicken, but they do have to evolve from here. And in fact, to some degree, it's kind of almost more exciting because it's like they get to really focus on what they're good at.
I would love that to be the case. And the I would say the magnanimous, the truly intellectually smartest of those funds of funds would take such an approach. And of my experience over the last 12, 18 months, the majority of them lack that approach.
Well, exciting times. Look forward to following your progress over the coming months and years. Good luck with it, and thanks very much for coming on to Fun Chat.
No, thank you for taking the time. Maybe we'll give you one other thing. You want to talk about your considered alternatives and all that little pitch?
Consider the alternatives. Absolutely. Yeah. Well, I mean, these are alternatives, aren't they?
Well, I've often quoted others, but I'd say I still truly believe myself too, that the alternative in finance, alternative investing, is the public markets. Your core holding, what you want to have is your money invested really, really smartly in private markets. And so long as it hasn't been drawn and isn't yet invested, the alternative is to hold it in public securities.
Controversial. So that means there's a lot more growth and upside for private markets as a whole.
Certainly the alpha exists in private markets relative to public markets.
Do you agree, Matthew? Yeah. I have to say I do as well, but I'm just checking. Great. Thanks very much, guys.
Thank you.
You've been listening to the Fun Chat podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.